Wilk. I'm the founder and portfolio manager of Greystone Capital Management. Here with me today is Bill Wood, president and CEO of Sylogist, a public sector software company that caters to nonprofit, government, and education organizations. Full disclosure, our firm owns shares, and Sylogist offers a purpose-built SaaS platform to over 2,000 customers made up of ERP, CRM, accounting, and various other software tools that are built on the back of the Microsoft Dynamics ecosystem. Since Bill's hiring in 2020, Sylogist has transformed their business in a number of ways, leading to a much stronger organization than the one he inherited, and one that's now focused on profitable growth and value creation. I've been really impressed with Bill since we met, and I think one of the things that I appreciate most about him and the business is that they have done what they said they were going to do, and I think we all know how important that is in microcaps. So I'm excited to get into the opportunity, and we have a lot to cover. So without further ado, I'll introduce Bill.
Thank you and good morning. And before I get started, I'd sincerely like to thank Ian and all of you for the opportunity to be here today. It's a unique forum for me to share the Sylogist story and for you to get to better know smaller cap companies with a compelling upside story, and I hope your takeaway is that Sylogist is just that. And my thanks to Adam for the invitation and for the insightful work that he's done to dig into Sylogist's past, present, and future, and the analysis he's done is spot on. As Adam shared, Sylogist is a software as a service company that provides mission-critical solutions to over 2,000 customers worldwide in primarily 3 public sector verticals: education, nonprofit, and government. These markets are big. Let's see if I can advance this here. Here we are. These markets are big and comfortably support several billion-dollar market cap companies. The public sector community is not early technology adopters. To the contrary, they typically hang on to the technology that runs their schools, a town, or a charity for a very long time. And I mean decades. That's great in terms of stickiness and LTV for the existing provider, but impedes organic growth and the adoption of new innovation in the sector. COVID changed all that, as it shined a light on how outdated their systems had become when they were unable to support the needs of their citizens, parents, and teachers, and donors in an online manner. And combining that with the reality of federal stimulus dollars now in their coffers that's specifically ear-tagged for digital transformation, and the growing fear from increasing headlines of another town or a school system having a security breach and their sensitive data being held ransom, they're now in a buying mode, unlike any time that I've seen in my 30 years in my 30-year career in the space. That's the sea change opportunity that brought me back to the space that I care deeply about and to Sylogist. For those of you that may know Sylogist of the past, I offer today we're recognizable in name only and our stock symbol. Today's Sylogist is customer-centric. We're disciplined allocators of capital. We're investing in profitable organic growth and 100% aligned with creating value for our shareholders. Sylogist today has a balanced Rule of 40 plus posture, and that commitment to profitable growth affords us the ability to self-fund investments behind the high ROIC initiatives that we've teed up. And our customers are also the beneficiary of these investments, as evidenced by our NPS score that's more than doubled in less than 2 years, going from the low 20s or good to now into the NPS top tier defined as great, with our most recent all customer scoring coming in at 51. That's important. It's really important because unlike other markets, towns are not competitive with one another, nor are school districts, nor are charities. In turn, they're extraordinarily collegial in that they share learnings, successes, and struggles with one another very freely. In turn, Once you get public sector customers advocating on your behalf, growth takes off. In my 30 years leading software companies aimed at the public sector, going all the way back to the founding days of Blackbaud, where I was one of the original 5, where we bootstrapped and ignited dizzying growth with no outside money whatsoever. Nothing, and I mean nothing, matters more than earning customer trust and advocacy in the public sector space. When I joined Sylogist a little over 2.5 years ago, I made a customer-first approach our North Star of our success ethos in everything we do. What that's now translated into is low CAC, high LTV, and strong new logo win rates. When I joined Sylogist in November of 2020, investments had to be made to change the trajectory that the company was on. The investments we've made since were rooted in a clear, informed strategy and included the necessary resource alignment to get it done in an uncomfortably tight time frame, and we did. That work culminated in 3 100% SaaS platforms, Sylogist Gov, Sylogist Mission, and Sylogist Ed. With the heavy R&D lift largely complete and alignment in place, we're now seeing traction in all 3 strategic markets. Sylogist Gov is our completely new local government and citizen engagement ERP platform for mid-sized cities and towns across North America. We had customers on legacy solutions in this space, but determined a rewrite made sense. Fast forward to today, customers are upgrading and going live on Sylogist Gov, and new logos are queuing in our pipeline. There's an exciting opportunity to win new business and market share in the municipal government space we're targeting, as several national providers have all but abandoned the small to mid-sized market, and many regional providers that are common in that space are struggling to, or choosing not to, make the needed investments to get their offerings to the SaaS posture that cities and towns are now demanding. In turn, the small to mid-sized local government is begging for a modern solution, and Sylogist Gov is just that. It's also the only Microsoft Business Central-based ERP solution available for the municipal government market. That's a big deal, as more and more cities and towns are adopting Microsoft as their provider of choice. Sylogist Mission is a combination of Mission ERP and Mission CRM, is the only 100% SaaS, fully integrated fundraising to finance platform for nonprofit organizations. It's a big competitive advantage for us, as it offers charities end-to-end data visibility in terms of the dollars they raise through Mission CRM, that's seamlessly integrated with Mission ERP to track how those dollars are put to use, that can then be reported back to the donor or grant-making entity in real time relative to how their donation is making a difference, especially with the AI and ChatGPT capabilities we've already built in. That end-to-end capability is something that I've been chasing for almost 2 decades, and one that we've made happen at Sylogist with the acquisition we made in October 2021 of what many consider to be the most innovative new fundraising software on the market, Mission CRM, and then made material investments to seamlessly integrate that with our well-regarded ERP solution. The Sylogist Mission platform now provides mid to upmarket nonprofits with incredible capabilities and clear reasons to replace their existing systems. To give you some context, more than 50% of Blackbaud's 10,000 nonprofit customers using the Razor's Edge fundraising software are coming up for renewal in the next 18 months. Blackbaud has made little investment in their core software for several years. It's become long in the tooth, and customers are not happy. With that backdrop, they stated on a recent earnings call that they plan to materially increase license fees to those customers as their renewals come up. We're licking our chops. We've already replaced several, and we're ramping up right now to grab market share from them and others. Last but not least, Sylogist.Ed is a platform designed specifically for public school administration. Not the classroom, but behind the curtains, the finance, the budgeting, all of those activities, student information, etc. Although Sylogist already had 3 school administration software companies in its portfolio, I determined that the technology and the cost, time to market, and risk to rewrite into a modern accounting, student information, grading, scheduling, lunchroom, state reporting, etc. solution was significantly greater than acquiring what we wanted, and I knew a company that already had it. We approached the founder and acquired Municipal Accounting Systems 4 months later in March of 2021, and its modern, fully SaaS school administration software in use at 450 school districts in Oklahoma. Since the acquisition, we invested to lift and shift that technology, rebranded it Sylogist.Ed, and penetrated another state, North Carolina. I'm pleased to report that we now have one of the top 10 largest school districts going live on Sylogist.Ed in the next few weeks, and many other school districts expected to do the same in 2024, marking the beginning of the strategic expansion of the Sylogist.Ed platform in North Carolina, and we've already targeted expansion to two other states in late 2024. If I have a paranoia relative to running a company at speed, I figure if we don't fill the vacuum, somebody will. And to that end, our strategy is to gain scale in the shortest possible time frame. And to that end, we're committed to a partner channel strategy led by our strategic partnership with Microsoft and their massive partner ecosystem. Building out a high-quality, high-performing partner channel is a key priority as it broadens our go-to-market reach, expands our implementation capacity without having to materially grow our headcount, and most importantly, focuses our revenue growth on high-margin cloud subscriptions and ARR. Let's talk a little bit about the numbers and kind of where we've come and where we are. As you can see, there's a marked difference between the former Sylogist and Sylogist today. On the left side of the graph, you see organic growth that was non-existent in 2019 and years earlier too, if we pulled that back. There was a myopic focus on EBITDA, and in turn, revenue erosion had begun due to virtually no investments being made in the products, customer service, or sales and marketing. And that revenue erosion was accelerating when I joined in 2020. Due to the strategic investments we've made, active customer outreach, and the team's incredibly strong execution to plan, we caught the proverbial falling knife and hit our trough in Q1 2022, at which point our revenue decline had accelerated to 11% in that quarter. We turned it around and effectively drove 17% organic growth in 2022 from that -11 to the +6 in Q4 2022. And now we've reported consecutive quarters of 20% plus organic growth in 2023. This is the culmination of the recruitment of a very experienced and talented management team, many of whom I've worked with previously, with deep public sector experience, knowledge in how to build and scale a SaaS company, and punches well above Sylogist's current market cap size. The effective execution of strategic M&A as an accelerator of organic growth, and the willingness to endure short-term discomfort to jumpstart organic growth and build a long-term value creation model. With an annual run rate already above $62 million, over 60% of which is reoccurring, and EBITDA margin percentage in the mid-20s, our Q2 23 results continue to demonstrate the execution on that profitable growth strategy. One metric I want to draw your attention to relates to the year-to-date project services growth, the dark blue section, and to the last bullet on the right, noting a 64% attachment rate of all project service revenue to our IP. That's really relevant to the trajectory we're on and the leverage ahead, as it's a key leading indicator of SaaS ARR growth to come, which takes 12 months to be fully recognized once an implementation is complete, and then becomes a high margin annuity for years afterwards. This slide further illustrates that point. And what you see here underpins we're now a fully SaaS-centered company. We crossed over in approximately May of 21, and since then the majority of our reoccurring revenue is coming from subscription revenues versus support and maintenance contracts. And those numbers aren't made up. It's truly the inverse, 37 over the 63. Let me quickly share our thoughts and my thoughts on capital allocation. Once we had concrete data and results that supported that our strategy and execution was taking hold, we significantly cut the long-standing dividend to free up cash flows. Doing so allowed us to self-fund additional investments to accelerate the profitable growth we've achieved. And when the share price fell to what I consider to be the ridiculously low range with the tech sell-off and since, the board moved quickly to put an NCIB in place that we're now exercising thoughtfully. And during that time, as we exercised it, created shareholder value. We also see the pay down of the relatively modest debt in the low 20s, 20 million, we took on to execute the 3 acquisitions we made since I joined as a key capital allocation strategy. 2 reasons. Interest rates have risen, as well as I don't want to be. We have a $125 million credit facility available to us, but I always want to keep dry powder and not be hamstrung with regard to a credit facility that we can't exercise at the right time should we need it for the right reason. But a key point I want to emphasize here is that M&A is a means to accelerate organic growth, not a mechanism for revenue growth for its own sake. Said differently, we are not interested in chasing the shiny new object or feeling we need to go outside of the huge 3 core markets we're focused on. M&A is not critical in our ability to deliver the growth and value creation we see ahead. I can also assure you that when we do more, and if we do more M&A, we do not plan to use Sylogist paper at its current rate until it's materially higher, if and even so at that time, as to avoid shareholder dilution. As I said, we see the SaaS flywheel gathering momentum. We see accelerating SaaS revenue growth and continued strong execution, especially around our partner channel strategy, driving greater operating leverage and increased gross margins ahead. Why Sylogist? Why now? First, because of the material growth opportunity we see ahead within the 3 massive markets we're focused on that are moving into buy mode to replace their legacy systems for the reasons I shared. Second, because of the effective execution of our strategy that's occurred and is continuing every day, that's now showing up in our financial performance. Third, because of the extremely positive reception we're getting to the SaaS platforms and customer-centric approach we're bringing to the markets we know very well. Each of the 3 markets is ripe for a new major provider, and our plan for Sylogist is to be just that. Fourth, for the significant opportunity we have to grow both our top and bottom lines and create exciting shareholder value in the quarters and years ahead. To that end, our KPIs are all materially trending up and to the right, indicating the health of our business and the continuing profitable growth and increased operating leverage we see ahead. And we're just getting started. We're just getting started. So I'll stop there and move into some of the observations or some Q&A with Adam, so I welcome that.
Thanks for the great presentation. So a lot of moving parts there. And if you go back and kind of look at the history of the business, you'll see that there are some moving parts as well since you're hiring in 2020, a management change, some new board members, strategy shift, dividend cut, a lot to sort of sift through. I just want to start by sort of talking about the path from your hiring to today. Obviously, you guys have accomplished a tremendous amount since then, and you've now transformed the business into a different one than the one you inherited, as I mentioned in my comments earlier. So for those less familiar, can you maybe just touch on what you stepped into, maybe on the customer relationship side, and now with kind of most of the heavy lifting done, where you think you are in terms of the process of kind of righting the ship?
Yeah, I think as the prepared comments kind of indicate, there was work to be done, and I think that EBITDA focus, which was really more of an inorganic strategy. What can we acquire? How can we find accretiveness? How can we skinny it up, tether it out, create cash, buy the next one? In the public sector that the company serves, you can only do that so long, and at a certain point you start to reach the inflection point of customers no longer supporting you, putting up without the lack of investment in the products, as well as people and a partner that they can really count on. In the public sector, they are typically challenged with talent and staff. So the partner that they're looking for has to be more than just a vendor. And to that end, we needed to get around to that posture so that we could be more of a provider of solutions that they were looking for. And as I said, COVID changed all that, and my commitment in joining Sylogist was to get to a SaaS posture as quickly as we possibly could. And COVID bought us time. Had we had to jump on that moving train, if COVID hadn't really been in play, I think it would have put our opportunity to get to market and where our competitors may have been, that much us further behind and them further ahead. So to that end, it was really about people, processes, and internal systems to get out of the tribal nature of the acquisitions that Sylogist had made. There was 5 dev teams. There was 7 marketing systems. There was 4 finance systems. So really we had to look at all aspects of the company internally, as well as how we were messaging to our customers that we were committed to their future and that we were prepared to make the investments ahead.
That's great, thank you. In speaking to some customers and just doing some work on the overall value prop that Sylogist offers, it became pretty clear to me that your products are solving a lot of problems for your customers in your various verticals. That was evidenced by speaking to some customers prior to your tenure who indicated that despite not having any support system for the technology or not even being able to reach somebody at the company, they remained with the business, and I think revenue or customer retention numbers remained close to 100%. Can you you touched on this in the presentation a lot or a bit, and I'm wondering if you can just describe the customer value prop in your own words, and in kind of what ways does your software address some of those critical needs?
I'll start with that theme of the partner, because for the reasons I said, as technology accelerates, because they are slow to adopt anyway, when they do adopt, they're looking for somebody to help spoon feed not just the technology, but how can they get value out of it? How can they change the muscle memory that they've used in their legacy system for maybe 20 years and make sure that their teams feel empowered, not impeded by this new solution that has been brought in. I think that because of the customers, donors, parents and teachers, as well as citizens and community, that drum gets loud in terms of what's expected. And so to the extent that we need to make sure that it isn't just a technology play and pushing it with a technology theme, but that we can help them be successful with it and successfully transfer from where they are to where they want to be. And to that end, our differentiation is really, someone could say an ERP is an ERP. What can you change in GL or AP or ER or budgeting or taxation in a town or student information systems? The big part of that is predominantly moving from true green screen technology with servers in the basement or somewhere within the district or town that they all have to something that's more modern in the cloud. So it isn't necessarily just about the functionality that we're trying to lead with. I'll be damned, I've been in too many of them. Technology war is not where I want to be. It's how we can deliver trusted solutions to them, get their data from where it is to where we want it to be in our new platform, and then help them understand how they can get their jobs done first, and then what we can add on to that second. And so that's really the transition we take them through in that partner and we've made all of those things largely self-service. We go in and do a material involvement in terms of helping them understand first and foremost, but training or orientation is not an event, it's a process. And to that end, we've moved most of our training to all video on demand, free. And we also have our knowledge base, which is AI driven now, where in product they can solve and get real content, videos, a person talking to them in play relative to what's going on. So we are really leveraging technology ourselves to make it easy for our customers to transition and to then leverage their investment and get a return on their investment and feel good about it.
I think that opens up a lot of opportunities for the business. And you mentioned, I guess, the importance of improving your NPS score can't be overstated at this stage. And if there's any additional color to add on the importance of that and kind of what opportunities that opens up with existing customers, I'd love to hear your take on that, kind of setting aside the new customer growth aspect.
Yeah, we poured in both personal political capital, reaching out, putting our words on the line, doing what we said, under-promising, over-delivering for the last couple of years, because the market overall has been promised too much and delivered too little over the 30 years that I've known it. And I've been a part of it, and I've been on both sides of that coin. I said to the board when I joined, I was not interested if this was really about me going and using my political capital in the space in a way that I didn't think was truthful and transparent, that we could over-deliver. And I say that to you with the same earnestness and sincereness. Sylogist is for real. Our products are real. The people behind them care, they do really good work, and our customers now feel that. And we were churning, we were losing revenue. We had some big cliffs that were coming within 12 months of when I started, and I said, give us some time. I know you're not interested, and then COVID accelerated. So as I said, it bought its time. No one was going to change their ERP during that time. And so to that end, or a school district wasn't going to make a change in the system. So it actually bought us about another year to be able to not just go and state the words of we're going to get this done, but then to start to involve them in our roadmap and what was happening to build trust. And then we ultimately went to them first. Before we started lighting up new logos, we took the key voices within our customer community that we knew of, that were advocates in terms of and seen as leaders amongst their peers, and went to them first. And basically rolled it out with them through a strong voice of customer lens, and basically rolled it out to them in a way that they could become the sounding board for their peers to start to accelerate. So we kind of stuck a finger in the dike with our words, followed them through with regard to keeping them involved in the dev process, went to the key leaders within each cohort, and then have built from that point forward.
That sort of collegial environment that you again mentioned today in your presentation is something that's maybe unique to your space. And I'd love to just hear your thoughts on that concept and maybe speak to the sort of dynamics that help drive both repeat and new business there.
There's just nowhere to hide. You cross one, don't deliver on one, disappoint one, they all know about it tomorrow. If you do them right, the other side of the coin works in your favor in terms of acceleration. There's nothing like the public sector for the reasons I share that just share with one another. Within the charitable space, they move around all the time as well. Not as much in school districts and gov, but on the nonprofit side, you typically move over to move up in terms of the idea to further your career. And to that end, what experiences you had along that journey largely dictate how you think about a provider such as Sylogist. These are not nice to have systems for these organizations. They are the systems that run those entities. We are as sticky as they come. Our LTV is through the roof, but if you get going the wrong way, that can turn on a dime. because not necessarily will they change overnight, but they will influence those that are in the market to say, nah, you don't want to be there. You don't want to be there. And to that end, it's all I've ever known, because for 35 years, the public space is the ground I've had my ear to, and I've come to appreciate that maybe at a higher degree than most other execs in the space.
Great, and then switching gears to the competitive environment, I thought you did a great job in the presentation of just laying out some of the relevant KPIs that investors should follow over time, and wanted to dig into those a little bit more, maybe 1 to 2 in terms of win rates and new logos. Mm-hmm. Maybe we can start on the nonprofit side and then touch on government or whatever you'd like. But I'd love to get your take on the current competitive environment within your end markets, and with respect to those KPIs, how you guys are insulated from some of the larger players like a Tyler or Blackbaud, maybe referencing the comments you made about their renewals coming up for maybe 50% of 10,000 of their customers, which is a significant opportunity. So anything you'd like to share regarding the competitive environment would be really helpful.
Sure, I'll kind of take them individually. On the gov side, you get the big players, the household names, if you will, that are uber focused on the big cities. They don't scale down well in terms of their pricing or their delivery or their support. And to that end, when I mentioned the mid-market that we're aimed at on the gov side, there's a lot of legacy players out there that have served those kind of regional areas for a long time, that are now really struggling or choosing not to get to a SaaS posture. And so to that end, while there is an RFP from time to time that we run into where maybe a Workday tries to bleed down to a medium-sized city or town, usually that's a bridge too far for that town because of pricing alone. And to that end, I feel very good about where and why we positioned ourselves where we are. It was part of our thesis buildup, is where is opportunity. It is the only market where chasing the smaller size ones is one that I'm interested. We are not down market, if you will, in school districts or in charities. I've learned it's really hard to make money there. The needs are insatiable, and the idea of turnover is just too great. And so to that end, I feel we are well positioned. The big players are across the top in the gov side can effectively bleed down for all the reasons I said. On the ed side, very regional again, because state by state, you have a lot of idiosyncrasies in terms of covenants, in terms of how education is delivered, how student count and classroom sizes are affected, how state reporting is mandated in terms of nutrition, in terms of all various things. So we are focused on the upper to upper middle portion of the school districts. And when you think of a large state, it may have fewer school districts than something like Oklahoma that has 450. Well, what they have is very small school districts because the concentration of their population is spread out. So ultimately, it's regional players have dominated that space, but they're just running out of gas. They're just running out of gas. Opportunity for us, but it also creates M&A opportunity for us, not for their IP, but for their customer community, just like we demonstrated with the acquisition we did of Oklahoma, which ultimately we were able to ride their coattails in, their strong relationships, and really insulated ourselves from somebody like a Power School or Infinite Campus or something like that, that much like in Gov, they don't bleed down well. And frankly now, it was the system to buy 7 years ago, 8 years ago, and now most school districts are saying, I'm not getting value. It's far too complicated, and mostly those systems have shifted to the classroom because during COVID, that's where they made money. And ultimately, I think their pivot back has left quite a few unhappy customers where they didn't further their product, didn't support them at a time when they really needed them during COVID. And on the nonprofit side, I think I've spoke to that in spades. We have the best technology on the landscape. We have the most innovation on the landscape. And we are now given reason, have strong case study as to why a charity may move over to a new solution that combines that end-to-end visibility of the fundraising activity with the finance and that full circle visibility to be able to feed that back to the grant making entity and so on. There's just nobody else there. Blackbaud's not going to get there. The key players ultimately are still very siloed, and their technology is getting longer in the tooth every day. And to that end, I think that we have at least a 24-month head start on where we are in that front, and I think we'll just continue to accelerate without a lot of material R&D left. But I do believe that our front runner status on the AI side, we will further accelerate and further separate ourselves from the pack.
Happy to ask one more question, or we can open it up. Yeah, we have about 3 minutes or however long, so yeah.
Questions? Got maybe time for 1 or 2 questions?
Thanks, great presentation. Congrats on transforming the company. As you look forward in terms of the growth rate, what do you see over next, let's say, 2 to 6 quarters? So I think it's easier to see from a negative drop to come back and into 20%. That's pretty good. Do you see that as sustaining, or you see a little bit up and down before you actually take off? Thanks.
I'm comfortable, and I've signaled to the street that mid-teens I'm very comfortable with in terms of growth rate. I hope you come to know me as under promise and over deliver to that end. I think that we are on pace and have every reason to believe that we continue to drive growth, especially as we kick in that partner channel strategy, which is really will most likely blossom in the 24 time frame as we are now. And it's not just any partner, it's the right partners that can deliver and make sure that they have the same NPS outcome that we would have directly. So I feel very good about our ability to scale without a lot of burden in terms of OpEx and continued gross margin elevation as we move forward. So I feel good about, if not accelerating growth as we go forward.
Thanks.
Just speaking a little bit more about that growth, I know there's a bevy of products that you guys have between Serenic, WenGage, and Mission CRM. Can you maybe elaborate a little bit more on which specific products you expect to have more growth than the others?
Yeah, and kind of shakes me a little bit. Those are our legacy brands, if you will, that we've now rolled in. The key in our thesis is ERP and finance is at the center of all of those market initiatives. They're largely all Business Central based. So we have common IP that we've deployed in 3 ways, which all have a fund accounting demand in the public sector that isn't in the traditional accounting sector, which means a lot of do-froms and things like that. That's unique to the sector. We feel very good about the continuation of our growth in the mission sector because of the opportunities that I mentioned in terms of not only Blackbaud alone, but several others, both in terms of organic and inorganic where we can roll up. On the Gov side, it's wide open. We've estimated greater than 1,000 opportunities in Canada and 10x that in the US relative to I'm not a guy that speaks of TAM. I don't like the term. What of the TAM do we think we can go get? We think we're aimed at the bell curve for a reason, and we think we can get 50 to 60% of that opportunity that we think will become available over the next 3 years. And on the ed side, it's a state-by-state sludge, if you will, and because of that. But once you get in-state, you can grow very quickly. And to that end, that's why it's not a get to 8 states in 24. It's get into a state, understand it. We already have customer outposts for the reasons of some of the legacy apps where we can build off of those. So we see ourselves as a 5 or 6 state player with a dominant position over the next few years, which should drive that market. Those 2 markets right now in terms of our growth are largely negligible. Those are free to us right now. We're not getting anything really in terms of those growth numbers from those 2 market segments, Gov and Ed, at this time, which we see accelerating in 24 overall.
Thank you, Bill. Thank you, Adam.